Welcome to another Market Insight Call, where we sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. Joining me today, as always, is Chris Ahrens, Director of Investments. I'm Aaron Tuttle, Chief Investment Officer. Chris, we're not doing these as often. I kind of miss the frequency. I don't miss the work, though, that are required to do those as often. But why don't we, instead of recapping, look at the whole year? Because we're coming towards the end of the year, and I'm sure everyone is wondering what happened. And then also we'll get into what we think is going to happen going forward. I know there's a lot of headlines out there to talk about.
So I just pulled the simplest chart possible, just prices on the S&P 500, and I broke it down into about 4 different periods. You could draw a fifth in there if you wanted to, but really it was just the story of failed rallies. So at the beginning of the year, you have this new low created in March and a rally, but we did not get back to new highs. It would be a failed rally. Sold down again through May. That's where I have that number 2 written. Another failed rally, failed to make a new high and another new low. So we start a new low in June, and this is a period where we had really high inflation, and people started seeing, well, prices aren't going to keep growing at that pace, and they said, well, that's probably peak inflation's behind us. And that started a pretty long rally that lasted through August. Now this did break the prior high, but it didn't get past the high from March, April. So we are still. Yeah, so it's about 7% off of that.
Right.
So it's still a failed rally, and then creating another new low in October to this recent high that we had in December, which I think is going to end up being, again, another failed rally.
So we don't think that the worst has passed us yet. Probably retesting those lows at least, if not possibly more. My guess is probably is getting close to the end, though, of this downward trend, but not just yet. Let me explain a golden cross. A golden cross is when the 50-day moving average is below the 200-day moving average, and then it begins to pass that 200-day, meaning that the 50-day enthusiasm is greater than the previous 200-day enthusiasm.
Right, and those are trading days. So it's about, there's 21 trading days in a month. Right. So about 2.5 months of more optimism, market moving higher than what you saw in the last 200 days.
So what are we looking at here, Chris?
So I drew the last couple times that this has happened. So going back, there's a 5-year chart. So we can see in the end of 2018, we had circled in red, that's a death cross. That's that 50-day blue line going below the 200-day. Well, fast forward a few months, and now I circled in green, which I should have circled in gold, I'm just realizing that now, is the golden cross where the blue line, the 50-day, is moving above the 200-day. Now, as a trading signal, this would not have been a good signal. You would have sold and bought right back in at similar prices. So you really didn't get any good signal there. But what signal you did get is it went on to make new highs.
Right.
So this is saying you have all that optimism building up, and certainly technical traders do trade off of this. And we went on and made another new high in 2020. Now, the same thing in the center of our chart is 2020. We had that death cross. A few months later, this was that really strong V-shaped recovery. Well, you get the golden cross back up. Again, not a good trading signal here, but we went on for that sustained rally again, year and a half or so, where the blue line was significantly higher. We get into this year, circled in red, where we had the death cross, and we haven't gotten very close at all until recently, where there's been some short-term optimism and for the 50-day closing the gap. But again, we're not there yet.
And that's the thing that we're looking for, because one, it's not just a technical indicator. It's not that, all of a sudden the stars have aligned, right?
Right.
It's that there's enough uncertainty being cleared out of the system in the current prices that prices are beginning to increase on average relative to where they were in the 200 days. So it's the market saying, most of this uncertainty is clear. We're looking for that as a good signal to start to be constructive on the market. And to your point, the golden cross is a great signal for new highs in the future. This is not a good trading signal because the death cross isn't as consistent. It's that the 50-day crossing the 200 as a golden cross indicates that you're most likely, at least historically, you're going to go on to make new highs relative.
Right. And so we've been hedged equity, right, for the last couple months, where we've had the extra fixed income for short-term treasuries. So really the goal of ours would be to get that reallocated back into equities before this happens. Because this, and we actually do have a slide here showing the last 12 times that this happened following a bear market. So this will be one of the times. We have it marked with to be determined. 11 of the 12 went on to make new highs when that golden cross did happen.
Right.
So like I said, we want to be getting allocated before this, and this will be a good signal for when maybe there will begin a next bear market or a next bull market.
Historically, it's been very constructive. We think there's there's a reason for the phenomena. It's a lot of that uncertainty is finally coming out of that.
When do you think that's going to happen?
That's a great question, and I would go here. So we talk about the market being a leading indicator. And that's actually very difficult because we still have headlines of saying that there's a recession, and we think that a recession is coming. If you wanted to pin us to a date, well, we would go from what our economist is providing sometime in April 2023. But this is all probabilities. It could be July. It doesn't really matter. It's just that there is likely a actual full recession coming on. One that we're not going to debate on what the definition of a recession is. The market is already pricing in a lot of that. It's one of the reasons that we're not saying, hey, there's a recession, let's just get out of the market. Now, once that it becomes a certainty, you will still see some downward movement in the market. So we got to realize that. But as a leading indicator, once we're in that full recession, and once the Fed begins to pivot and start to lower interest rates, that's whenever you would see the beginning of the uptrend in the financial markets at the very low trough of a recession. And I think we're getting into that in the first half of 2023, and we want to position for that. So we're looking for that 50-day to come over the 200-day. We're looking for money supply to begin to not stagnate and be actually at negative growth, but begin to be positive. We're looking for the yield curve to move up and actually be positive. And those are the signals that we're going to use to go ahead and start redeploying some of those defensive positions into an economy that's about to rebound. So it's watching the Fed. It's determining how long the Fed's going to do it. And a lot of that data is starting to indicate that the Fed is going to pivot sooner rather than later, though there's some politics and some jawboning that they have to go through, and they certainly have to remain credible. But we're looking for some of these positions to change so that we can start to get invested prior and during the recession. And emotionally, that's going to be difficult. We're going to have to get aggressive and risky at the time where it's going to be at its darkest hour. So just know that, but that is the way that we're doing, and we're positioned already for it. Sure, we will participate in downside because we can't abandon the investment opportunity set altogether. We do have some defensive positions, and most of the time the market's in an upward trend. We're eventually going to get there. These downward trends, you measure them in months, you measure bulls in years, and we're probably getting late in the season of this bear market.
Because that inflection point, when it happens, will look really obvious looking back on
Yes.
it. But beforehand, heading into it, it's not going to be nearly as obvious.
You're going to feel very much a lot of despair at that moment whenever recession, unemployment showing up in a big way, and you're no longer talking about inflation, you're probably talking about deflation because prices of everything is falling, and that needs to happen, really. And we're positioned for it. We're more value tilt. We have cash. We still will participate in the downward market movement as well because we do have exposure to the market. But these are the things that we're looking at to be constructive, right, and move forward.
So we did just come off a Fed meeting last week, and it was a projection meeting. So they do give their projections for where growth's going to be, unemployment, inflation, and they also give their dot plot of what they think they're going to do with the Fed funds rate. So what we're looking at here on the right-hand side is the report we got last week. The left-hand side is the one they got from the same meeting a year ago. So if we look back to what they said a year ago, so the 2022 column, this is them saying right now, where it is now, but they were projecting a year out, where they thought rates were going to be. And they were saying they were going to increase rates 3 times to 75 basis points. Well, if we look on the right-hand side of what actually happened, they raised rates over to about 4.5%. So significantly higher than what they had said they were going to do. It's because of the lingering inflation, right? And this has done a lot of damage to the economy that you referenced that we haven't seen yet. And this is what we're going to be starting to see in the new year. And looking forward, well, they're saying next year, 2023, they're going to continue to raise rates to over 5%, somewhere between 5 and 5.5. What the market is actually saying is they don't believe them. So if we look at Fed funds futures, so traders and fixed income, they're saying the end of 2023 that the target rate's only going to be 4.25, 4.5, with some probabilities even lower than that they're going to be 4%. So while the Fed's talking tough, saying we're going to keep raising rates at the beginning of the year and pause, the market is saying no. Your fixed income market saying no. You're going to pivot and you're going to start cutting rates throughout the end of the year.
It's kind of a game of chicken right now.
Yeah.
So then, what if we were to look at, because inflation's been a hot topic in 2022 because it's been hot. What do you see in the market for inflation rates now?
So break-even rate, this is going to take the nominal bond, which most people just call 10-year Treasury, or the 5-year Treasury, we have both of them here, and compare that rate to the TIPS rate, the inflation-protected rate, and look at the difference between the real rate and the nominal and say, well, there's your inflation break-even. And they're getting anchored close to 2. We're looking at break-even inflation rates at 2 to 2.14. So that's coming in pretty low, meaning if you think inflation is going to be higher than that, you're better off buying the inflation protected. Lower than that, you'll buy the nominal bond. And so at least what the fixed income market's saying is something's going to happen that's going to bring inflation down significantly. Likely, they're planning for a recession.
Right. So the market is pricing in, and we could just do that by subtracting the normal bond from an inflation-adjusted bond to figure out what the market is pricing for inflation. And the market, not the Fed, not us, is assuming about a 2%. So that means that they would be back at their original target.
Which is good news. What's what the Fed wants to see, well-anchored expectations. It's coming down from 3 to 3.5 earlier in the year. So like I said, fixed income is planning likely for a recession. Also, when you look at spreads, which you referenced earlier, you can do a 10-year spread versus the 2-year, or you can do 10 versus Fed fund rate, which is what we pulled here, and just comparing that yield on what a 10-year bond's paying you versus something that's short term. And when they're expecting low growth, inflation, recession, you start to see inversions, and then it becomes self-fulfilling, right? Because banks are struggling to loan out money with lower rates and paying out higher rates on the short end. Well, we see that again right here. And every time before recession, this does happen. So again, just another predictor that fixed income markets are expecting recession.
This is something, once again, that we would want to see revert, I guess it's because it's inverted,
Yes.
Where when you're loaning somebody long-term money, you're getting paid more than if you're loaning short, because this is an issue right now. And to your point, it's the bank is paying a lot to keep deposits on the balance sheet. I'm starting to see CD rates that are frankly attractive. Yeah. That's because there's a lot of demand for cash, but it's really difficult to be making profitable loans out on the long end at the rate that there is a deposit. So absolutely. Now, one thing that we haven't seen in the index is some of the credit, because we've seen a couple of recession indicators. It's not showing up here on credit.
No. So what we're looking at here is high yield spreads. So this is the spread, the extra yield you're going to get for owning a bond that has default risk versus government bonds that do not have default risk. And when we look back, I drew 6 to 8% bands, because that's really where you start to see times of stress. When we look at this, you can see in 2000, 2008, 2012, 2016, and of course 2020, you're going to see spreads widen to at least 6 to 8%. And like you said, that's not happening in credit markets. Credit markets are moderately correlated with equity markets too. And we're just not seeing that happen here, while we are seeing a recession predictors on the other side of fixed income.
And a lot of people explain it away saying, well, energy is typically one of the hardest hit, with energy having a very good year. Maybe the credit spreads are not showing up because the energy fixed income is not
basically that you're
up.
Comparing a higher quality index now, while it wasn't as high quality back then. So of course you're going to have lower yields now. But still, most people are saying...
It doesn't explain all of it.
It explains some of it, right?
Right.
But you would still expect if there is strong recession, or even just a weak recession, these are going to increase.
So we're not seeing the credit spread recessionary risk indicator there. We're also not really seeing it in equities. PEs have certainly come down as a multiple. That's been a good thing. But they're near 25-year averages. So the equity market and the credit, which I know they're related, they're not seeing a recession. What are your thoughts here?
Yeah, when you look at what they're actually expecting, so the E for the PE, right, we're at about 16.8 on price to earnings, and the expected earnings is about $230 per share, which it's not a significant growth. The expectations for growth have come down over the last month or so from something like 7 or 8% to right now the market's really only expecting 5% growth. But again, you're not going to get 5% growth if you're going to have a decline in aggregate incomes, aggregate growth in the economy.
So we have mixed signals, and it may be that the equity market is right and the fixed income market is wrong, but it could be a more nuanced answer is, well, if the fixed income market's assuming 2% and most think it's somewhere around 3 to 5%, that's not a great option to buy. So then if I just add a little bit of credit risk and I add a little bit of equity risk to offset it, because there's just nowhere to really hide through this, I could be wrong for 12 months going through the recession, but right long term. So that might be one of the reasons that people are still favoring equity risk over fixed income risk, because yeah, it'll be painful for the short term, but long term, especially when the Fed begins to pivot, these are the positions you're wanting to be in. Since there's no place to hide, why not hide in this stuff long term that's going to work? So that may be an alternative component, and help understand why this is a paradox, meaning not a contradiction. There is an actual thing. You just have to scratch a little bit further down the surface to find out what that is.
Yeah, it's a great point. I was getting very short term in what I was saying, so thanks for bringing that back.
So the next thing is jobs. And we've talked about the jobs report several times. That we have the BLS report coming out, and it's saying that everything's great. And then you have the household survey that's saying maybe not so much. And there was discrepancy. And I tend to wear a tinfoil hat and to say, well, yeah, the BLS numbers are wrong. That doesn't mean that they were wrong intentionally. And they've recently come out saying, no, that we were assuming 1.1 million jobs. Maybe we got 10,000. Over this time frame. So that discrepancy has really been answered with a report that came out. Why is that important? Because one of the reasons the Fed has continued to be an advocate of higher and higher rates is they're saying, look at the employment. It's not bad. It's good. It's actually robust. We're adding all these household jobs. Well, if that isn't true, then that means the Fed could actually be accommodative. So that lends them the ability to begin that pivot soon. So this is one of those things where it's an indicator. We are moving in a recession, that there's a higher unemployment, or the employment situation has slowed. But it's one of those things that bad news starts to become the good news, because what we're waiting for is that Fed pivot, and we have one more argument or talking point taken away from the Fed that they no longer are going to be hawkish. Now we start to move to a more dovish Fed, which is what the market is wanting the Fed to do. It's just, once again, a game of chicken.
Yeah, and this report did come out from the Philly Fed. So at least you can argue that they haven't had credibility, but at least it's someone that has a seat at the table talking to them about what's going on. It wasn't just the tinfoil hat people that have been saying for a long time that these numbers don't make any sense.
They didn't make any sense, but it probably wasn't that there was any nefarious things going on, as often is the case. Now, that's talking about measuring. One of the things that we could talk about is our benchmark, because we're going to make some changes to some benchmarks going forward. One is the Muni Index. It's not as followed as it once was, so we need to get changed, and it's also not as easy to invest in that. So there's some characteristics that we at Gatewood Wealth Solutions use to understand and choose appropriate benchmarks. You want to talk about a few of these points?
Yeah, absolutely. So the acronym ends up being SAMURAI. So you want to make sure, hey, you're specifying in advance, it's appropriate, measurable, unambiguous, reflective. That's an important one, because that's where we're saying it's reflective of what you're investing in. If you're not investing anywhere close to what your benchmark is, and you don't think you will, well, you need to change your benchmark. Right. And then accountable and investable, like you said. You can have indices that could be your benchmark, but if you can't invest in that index, well, that's probably not a very good benchmark, because you can't buy the benchmark to compare apples to apples performance. So those two, reflective and investable, are the ones that stand out to me for saying there's probably some changes that need to be made.
Right, and the other one for me is that we need to specify it in advance. We don't get to go back and make a selection, so if you start to see benchmarks changed on your portal, it'll be going forward. We're not going to go find, hey, what benchmark makes us look good long term? Because that's not an appropriate way to benchmark. It would be really easy to beat your benchmark if you could always select it after the fact, right? You would just say, hey, which one underperformed our performance? So we are going to be making these some changes within the strategies. Right now, if you look at your benchmark in the portal, it's a global benchmark. It's comprised of U.S. large cap, mid cap, and small cap, as well as international developed markets, which is mainly Japan and Europe, as well as emerging markets, which we can probably get into some of the makeups of these as we go along, as well as the Dow Jones real estate. And we've used historically commodities, and then depending on what your fixed income allocation is, we've been using the Muni or the Barclays Ag. So this is what comprises of that benchmark that we're measuring against. It's a good, appropriate benchmark. But there's some issues that come up with trying to invest in it. One is, let's look at how the international market breaks out. If we just look at international market, 20-something% is in Japan. Is that a place that we want to invest? And it's having some changes. I know they have the yield curve.
Well, the best argument for investing in Japan lately, and people may make fun of this, has been, well, their central bank has remained accommodative. Well, if that's your main investment thesis into a country, I don't think that's very good. Right. There are now, of course, there are good exporters from Japan that are good companies, but the actual country has a lot of problems. That's why they're still staying accommodative. Right. The stock market's been flat for 30 years, but that doesn't mean it's gonna remain flat. And I'm sure many technicians are probably preparing to a trade for maybe some reversion. So there could be a rebound. And like you referenced news this morning that the accommodative policy, that they have pulled back some of it a little bit, and it did, of course, help the yen is running. So the dollar was weakening this morning against the yen, and it was hurting stocks over there because they, like I said, if the thesis is accommodative policy and they're removing some of the accommodations, well, you're going to see downward pressure in the equities.
And then if we look at the other part of it is developed Europe. We know the situation of the energy crisis there, as well as the geopolitics that are playing out. So these things have rallied here recently, but is it in a place that you want to invest? We think it's appropriate still to stay in a benchmark because you should consider that. There's a lot of things that can happen. It could be that these prices are low and they're about as low as they could go, and this is an opportunity.
When you're looking long term, so if you have a stock strategy, like our moat strategies, and you're going to hold long term, hopefully somewhere between 30 and 40 stocks, and you're going to say, well, if this is going to make up 25% of the investment selection, well, you're going to need whatever that is, more than 5 stocks that are representing this. Well, it's really difficult to find 5 good stocks that are part of this index.
Right. So then one of the things that will make a change within the stock strategies is instead of, for that account, comparing it to the global benchmark, we'll begin to compare it to the S&P 500. Why? Because we're mainly buying U.S. large cap stocks, and what's the appropriate benchmark for that? Will be the S&P 500. When you look on your portal, you'll still see your broader benchmark is that global opportunity set. Another area that we've struggled with, though, is emerging markets index. And once again, you start to go to the constituents. We got 30-something% in China, and we have another 14%. When you add these together, it's almost half of the emerging market index is China and Taiwan. And we know what's going on there and the risks that are there. So great index, but is this how you want to be invested? And then you got this short-term noise, especially where the dollar is losing value. These are hard indexes to follow at the moment because there's lots of risk there, but with risk you also get some pop. These have been,
and the pops can be significant too, right?
Can.
You can have China can rebound 30% easily, but right now when we're looking at it, it just does not look like a risk that we want to be taking.
Right. So, and there's no change to the global benchmark. We're going to keep these as is. But these are some of the things that we're going through and discussing in the investment committee because the last few weeks that international and the emerging market positions have hurt us, and we want to be very careful how we get the exposure there. And it may be there's some tracking error in the near term, but when we look at the risk versus that reward, we just don't see it as an attractive place to invest, and would rather just not have that as a position and trail in the short term. So then we had mentioned the stock strategies reverting, so those would have that S&P 500. A lot of the sectors are similar. You want to talk about the sectors?
Yeah, they can be pretty similar. So when we look at the S&P 500, you can look at energy. Well, energy is 5% of the S&P 500. It's also 5% of the global opportunity set. Defensive stocks, well, the S&P does actually get a little bit more that are categorized as defensive compared to the global benchmark at 26 versus 22.5. But it kind of balances out because you're going to have more technology in the S&P 500, right? The domestic index has a lot more tech companies, and that leads to about 23%, while internationally and globally they only make up 16%. So there will be a lot of balancing of the two.
And we have had a significant overweight to technology for quite some time in stock strategies. One of the reasons we want to make this change to the S&P 500 is to get and look more like the S&P 500 and be able to make some stock selection and really reduce the opportunity set to those 500 stocks that are in the S&P 500 because we need to make a change to moat. It has worked historically very well and allowed us to have some concentration. The problem is some of the names, let's say Microsoft, Amazon, and other companies that make up a very large part of the S&P 500 and also our positions has really drove a lot of performance, but we have a 10% rule that says try not to take more than 10% long-term gains relative to the account size. And that's a prudent rule. But as the value of those stocks became higher and higher and we couldn't get out of them in a significant way without a lot of tax liability, we have to rethink our strategy. One would be just get rid of the 10% rule, but we think that's a prudent rule. So the alternative would then to start to reduce the amount of exposure you have through concentration, or another way to say simply is just add more names. Now, by necessity, if you pick your best 5 guys for your basketball team and they say, well, pick 5 more, your next 5 picks are not going to be the ones that you're as confident on before. But the flip side is you now have more names. You have more diversity in there, so that actually reduces some of the risk exposure. So we think by adding more names, we're going to have, one, a little bit more ability to get around these tax consequences because there's more ways to move the portfolio, more names with less tax liability to do so. And we can monitor these on an ongoing basis, similar to the way that we were on Moat. So this is, I think, going to be a really good change for the strategy, allow us to be more nimble and do some of the factor weightings by picking different names. So I'm really excited about this change for Moat. I think it's going to be a lot more clear on what's happening because they don't have a lot of the legacy names that had developed in the previous strategy. So there is an update on this strategy or a change to the way that we're placing these names in the portfolio. They'll still have a wide or possibly narrow moat, so that subset is still something that we're looking at. So it's still appropriate to call this the moat strategy. Yeah. Any other comments on the moat strategy?
No, it's also going to be easier to see. So the next slide, we have a quick example of our weightings compared to the S&P 500. So you see, well, we have a 17.5% weighting to technology. That's actually almost 6% lower than the S&P 500. But you compare that to the global benchmark, we were actually overweight technology here. And it's a position we've been reducing and adding over to consumer defensive at 14%, which is a 6.5% overweight to the S&P 500 for that sector. So this is just what it looks like behind the scenes, and it's very simple to follow against the S&P 500, much more reflective of the investments that we're making.
So then we've talked about the global benchmark, which will remain the same. We've talked about how individual stock strategies, since they're mainly U.S. large cap focused, will be compared to the S&P 500 at the account level. Another benchmark that we are considering adding is what we would call the planning benchmark. And this is something that you probably remember whenever being onboarded by your lead advisor, the ideas. And we are trying to figure out how to actually place this on the portal, where it is, if your plan assumes a 6% or a 5% or a 4% static return, where it's just that straight line, can we get that added to the portal so that you can see, am I on track from the plan, which is to be outcome focused? I'm not worried about the global benchmark or the S&P 500. Am I getting enough to make my plan work? We want to get those added, and that will give us some added ability to kind of make some changes. So whenever we're well ahead of that planning benchmark, you can have that conversation with your lead advisor. Hey, is it time to add the amount of cash, or should I become a little bit more conservative, maybe increase the fixed income exposure because I have a long-term return of 7 or 8 and I only need 5. Or on the other side, whenever we have market sell-offs like this, Can I become more aggressive? So we're hoping that this information starts to give us more details to make informed decisions. Decisions around the plan, not the emotion, because when markets sell off, that's whenever everyone wants to become more conservative. But this benchmark, if you're below it, says, but you need to be more aggressive. Now, we're not saying that you just automatically change depending on where you are relative to this benchmark. Obviously, talk to your lead advisors. The lead advisors are also talking with us to kind of get the take whether we're constructive. So if you were below your benchmark right now, I wouldn't advocate being aggressive just yet. I would wait for that recession signal and some of the signals that we're talking where we became constructive, and that would be the time to go from, let's say, an 80 or a 60-40 strategy to maybe an 80-20 strategy, because most of the market is now well below average historically. Now is the time to add that risk. So we're going to call this the planning benchmark. We're still trying to work this out through the portal provider on how to get this put in there, but those are the new benchmarks that you'll see. The same global benchmark you've always seen. The S&P 500 for individual stocks, so you can have a better comparison of apples to apples, as well as a planning that we hope to get out in that first half of the year. Anything else that you want to cover, Chris?
No, it's more reflective. Just to state the obvious, the S&P 500 has been a very difficult benchmark to beat. It has a strong return profile that it's had for years.
Yeah.
Just so I just want, like you said, we're making a change in advance, and it's not because we're trying to escape anything. Right, this is actually a very difficult benchmark to make, but it's much more reflective of the strategy.
It actually makes the conversation, no longer can you say, well, you're comparing apples to oranges, right? You're comparing this U.S. stock strategy, which it should be the S&P 500, and then whenever it's favorable to do the, so this actually becomes more accountable to saying, well, this is a large cap strategy, this is a large cap index, let's compare them appropriately. Are you ahead of it? Or are you behind it? So I think that if anything, it actually brings more accountability. Well, we really appreciate you joining. Sorry it's a little bit longer this time, but then again, we've been doing them monthly, so maybe it's good to have, if you like a little bit longer, go ahead and hit that like button. And they don't have the dislike button, so if you don't, well, we really appreciate you joining us. If you haven't subscribed yet, hit that subscribe button, and feel free to share this also with your friends so they can get an update, because I know there's a lot of headlines and a lot of scariness out there. It's certainly a time to be cautious, but I would not be making changes to be too conservative at this point. Most of the damage has already been done in the S&P 500, and we're probably getting closer and closer to a recovery scenario with probably one or two more fades to the downside on this downward trend as we wrap it up. All right, well, we really appreciate you joining us this week, and we will look forward to you next month. Thank you.